Capital expenditure, CapEx. Capital expenditures are funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. For example, CapEx can be spent on building a new factory or purchasing a piece of equipment. This type of financial outlay is made by companies to increase the scope of their operations or add some future economic benefit to the operation. CapEx can tell you how much a company invests in existing and new fixed assets to maintain or grow its business. Put differently, CapEx is any type of expense that a company capitalizes or shows on its balance sheet as an investment rather than on its income statement as an expenditure. Capitalizing an asset requires the company to spread the cost of the expenditure over the useful life of the asset. The amount of capital expenditures a company is likely to have depends on the industry, and can be found in the cash flow from investing activities in a company's cash flow statement. Many different types of assets can attribute long-term value to a company. Therefore, there are several types of purchases that may be considered CapEx. The formula for CapEx is the change in property, plant, and equipment plus the current depreciation. Capital expenditures are also used in calculating free cash flow to equity, FCFE, which is the amount of cash available to equity shareholders. Aside from analyzing a company's investment in its fixed assets, the CapEx metric is used in several ratios for company analysis. The cash flow to capital expenditures ratio relates to a company's ability to acquire long-term assets using free cash flow. A ratio greater than 1 could mean that the company's operations are generating the cash needed to fund its asset acquisitions. Capital expenditure should not be confused with operating expenses. Operating expenses are shorter-term expenses required to meet the ongoing operational costs of running a business. Expenses are considered CapEx when the asset is a newly purchased capital asset or an investment that has a life of more than 1 year, or which improves the useful life of an existing capital asset. As part of its 2021 fiscal year-end financial statements, Apple Incorporated reported total assets of $351 billion. Of this, it recorded $39.44 billion of property, plant and equipment, net of accumulated depreciation. These balances are dictated by generally accepted accounting principles. The rules, treatment, and policies a company must follow when accounting for CapEx usually mirror Apple's treatment below. In a hypothetical example, ABC Company had $7.46 billion in capital expenditures for the fiscal year compared to XYZ Corporation, which purchased PP&E worth $1.25 billion for the same fiscal year. The cash flow from operations for ABC Company and XYZ Corporation for the fiscal year was $14.51 billion and $6.88 billion respectively. CF to CapEx is calculated to analyze the company's ability to acquire long-term assets using free cash flow. CapEx are the investments that companies make to grow or maintain their business operations. Unlike operating expenses, which recur consistently from year to year, capital expenditures are less predictable. Capital expenditures are not directly tax-deductible. However, they can reduce a company's taxes indirectly by way of the depreciation that they generate. The key difference between capital expenditures and operating expenses is that operating expenses recur on a regular and predictable basis, such as in the case of rent, wages, and utility costs. Operating expenses are shown on the income statement and are fully tax-deductible, whereas capital expenditures only reduce taxes through the depreciation that they generate. CapEx is an abbreviated term for capital expenditures, major purchases that are usually capitalized on a company's balance sheet instead of being expensed. When a company acquires a vehicle to add to its fleet, the purchase is often capitalized and treated as CapEx. The cost of the vehicle is depreciated over its useful life, and the acquisition is initially recorded to the company's balance sheet. Here are 5 key takeaways. 1. Capital expenditures are payments made for goods or services that are recorded or capitalized on a company's balance sheet instead of expensed on the income statement. 2. Spending is important for companies to maintain existing property and equipment, and to invest in new technology and other assets for growth. 3. If an item has a useful life of less than 1 year, it must be expensed on the income statement rather than capitalized, which means it isn't considered CapEx. 4. Unlike CapEx, operating expenses, opex, are shorter-term expenses used for the day-to-day operations of a business. 5. Examples of CapEx include the purchase of land, vehicles, buildings, or heavy machinery. Hope this would help. Thanks for watching.